I have some notes here. We are going to jump on in first and foremost with intros. And we're going to jump in with, okay, first of all, what stage do you invest? How long have you been doing this? What brought you to becoming an investor? Typically, people aren't just an investor. Sometimes they're an operator or came from another firm. And then, do you have any investments in Utah? So go ahead, Tomi.
Testing. Okay, there we go. Hi, I'm Tomi Smith. My background is actually owner-operator as a bootstrapper. So I've owned a couple of service companies. I come from the CEO aspect. I just got involved with the startup world and the investing world 4 years ago. I now help run and operate a company called Keiretsu, which is one of the largest angel groups worldwide. And then I also sit on the board of directors for the Northwest Angel Fund, where we invest in companies and decide how to help angels, investors, and first-time investors get their money sooner and be more involved with companies to help them be more successful.
Thank you. And I think we'll probably dive into like what categorizes an angel investor. What do you need to be an accredited investor? We can jump into that as well. Do you want to describe what it takes to be an investor? An angel investor?
Yeah, so how we describe angels investors, meaning that you're part of an angel group, having a conversation, having mentors around you. We're actually connected, and we have a syndication partnership of over 90 angel groups. As far as an accredited investor, most of these angel groups have accredited investors within their groups, and so to be an accredited investor, you need to make $200K or more a year, or $300K as a family, or finally, 1 million in assets that is beyond your residential assets. So that is a lot of misconception, especially for entrepreneurs like me that could have been investing early or looking at deals like yours. I thought there was some type of test I needed to take. I didn't think I belonged in this room, but I definitely fell within those criteria. And had I been introduced earlier, I would have been investing earlier.
That's actually a really great point. So for people who are raising a seed round or even a pre-seed round, some people might already be accredited, but they don't even know it yet, that they're eligible to be an investor, an early stage investor. Thank you. All right, we'll go to Kristin. Can you describe how you got into this industry and how you invest?
Yeah, absolutely. Hi, everybody. My name is Kristin. Hi, Dylan. I work at Nucleus Fund. We're a state-backed fund. My background is a little unique in the investing world. I was in the Navy for a little over 8 years before I went back to school, did a graduate degree, MS and MBA, and then pivoted into investing after that. And part of, I think, what makes our fund so special is that we're investing in a lot of deep tech. And so I brought that deep tech experience with me. And then questions around, we invest in pre-seed and seed, and we're a state-backed fund by the state of Utah, and so all of our investments are in Utah.
Do you have to have a one-to-one match from private investing in your deals, or can you invest in something that doesn't have another investor in it?
Not a necessarily one-to-one requirement, but yes, there needs to be private investment as well. We're looking for something a raise that's going to enable that company to get to a significant milestone, just like any other investor is looking for, and that generally is not going to be achievable with just our check alone, as well as we can get into some of the details, but we have a student fund. All of the diligence is done by students here in Utah, and so we're investing state dollars with student diligence, and so it's really helpful to have that external validation on our investments.
Thank you. All right, Bob, you're up. Talk about your history and investing and what you're investing in now.
So for about, more than 3 decades, I came from more the operator perspective. So I ran medical device companies very opportunistically all around the world. Some companies you'd recognize, I worked for public, private, big, small companies. So I had the experience by being an opportunistic operator. I had an opportunity to be part of the evolution of certain aspects of medicine. So I was fortunate to be part of teams and also part of thought leaders that kind of, we watched the evolution of medicine realistically and of interventional medicine. So I had an extreme passion for serving patients initially. How I got into investing is eventually, after retiring from operating companies, I joined a couple boards, a couple here in Salt Lake, 2 private boards, and about a half dozen public boards. And so I've had that experience as well. We got into investing for a couple of reasons. The funds that I represent are, well, RDM Enterprises is my own fund, and then I have one that's called FF20, and FF20 is an interesting company because it's based on using my background, but my partner in crime is a guy named Jeremy Mustard, and he started Fortnite. And so you have medical device guy with a really smart guy. And it's interesting how we collaborate on different investments. For example, it's called FF20 because we try our best to forecast what does the world look like 20 years from now, and how can we fast forward today to get us there. We're also affiliated with a partner in Hexagon, if you've heard of Hexagon. It's more of a mid-stage investment company that is opportunistic in the way that they try to understand the Harvard hype curve. And so when you think about when every innovation follows a hype curve, and so we try to find out when the hype has run out so that we come into the right time. We've been pretty good at forecasting that, but it's less early stage than what FF20 is. So we kind of cross the gamut of how we invest.
And so since this is an early stage conversation, at Features, we define early stage as seed, Series A, and Series B. That is also a bit of alphabet soup because for us, that is really the first in human clinical stage. So the animal studies have been done, and it's really funding that first in human trial. Or if it's not a clinical company, it's funding the first revenue, so the early commercialization ramp. And oftentimes, we know a lot of the other funds in the industry. Oftentimes, we're funding towards what their initial goalposts are. And so if that's a certain number of patients or a certain amount of revenue, we're funding that slug prior to the next round. How does everyone on the panel define early stage?
Well, I would say you're exactly right. That's how we define early stage. So for us, it's definitely you're on your second human trial or first human trial, your seed, Series A. So you have some proof of concept, but you're past the point that grants have carried you, and you now need that next tranche of funding.
And grants are opening up again, so that's huge.
Yeah, a lot of similar. I won't repeat any of that. I would say that also we're usually in that first round of institutional capital. And so that may even be a little earlier than it sounds like both of you, depending on how far that company has gotten with grants. Our fund, part of our structure and our thesis is that everything we invest in is commercializing in partnership with an institution of higher education here in Utah. And so as that technology progresses inside of the university, once it's finally ready to go out into the world, we're in that round.
The definition of early is pretty broad in our perspective, crossing both funds, because we can look at ideas very early. We have a philosophy that we invest in founders, and if we feel good about the founder, we're willing to write smaller checks quite early, based even on a concept.
Hopefully that's helpful for everyone in the room. Can you define portfolio construction, how you're thinking about your portfolio, also where you are in your investment cycle with your existing fund or with your existing amount of capital that you're investing?
So our fund is, if you guys haven't caught yet, state-backed. So we have $40 million from the state of Utah, and it's an evergreen structure. So returns from the fund come straight back to the fund for future investment. So it sets us up a little different than, say, a traditional GP LP model, where you have a certain amount that you need to deploy in a certain period of time, and then you let that run. Meanwhile, you're raising your second fund. we, in order to continue to exist and continue to invest, need to make sure that we deploy at a speed where we will start getting returns before we've deployed everything that we already have. And so there's a bit of a math there, especially in early stage deep tech, like early stage life sciences, where how long will that take and how sure are those returns? So we roughly have deployed about 5 million of that 40 and try to stay somewhere on track around 4 million per year.
And check size?
Check size, initial check is most often 250,000. So we're making more smaller bets.
And then are you keeping reserves? And maybe define reserves.
Yeah, so reserves is how much you're ready to use for follow-ons, and we will do follow-ons. We include that as part of the 4 million that we're deploying per year.
Thank you. Okay. The Northwest Angel Fund and W Angel Fund, we are a private fund and we do run. So we do a $10 million fund. This is not our first rodeo. We've been doing this for 25 years. So we'll do a $10 million fund and then we'll deploy capital. We'll wait until that runs the course of time until everything's exited. We also look at reserves. So if we talk as a committee and we say, okay, what do we need to do to help this entrepreneur? Do we think they're going to need a second tranche? Do we think they're going to need some backing once they receive the first tranche? And so we kind of navigate that per who's in the fund. And then we take a 3 barbell approach. So we actually have a early stage where we don't go as early as concept, but we'll go as early as seed. Maybe they're only through their first trial. And then we do a mid stage. So when LPs are investing, they're investing in these 3 stages. And so we'll do a mid stage and then we'll do a late stage. So the late stage could even be in Series B or Series C. Our whole goal is that investors are receiving their capital within 2 to 3 years so they can reinvest in the ecosystem. We understand that innovation cannot happen unless we continually fund our investors back as quickly as possible so that they can move the innovation along.
Go ahead, Bob.
So as I mentioned, we can get in pretty early if we're compelled to do so with a bite size around 250 at a minimum. And we look at opportunities that are going to potentially change the world. But when you ask about what our portfolio is, we cross basically 5 pillars. Even though I'm focused exclusively on health with a focus even on med tech, our portfolio crosses everything from energy to water to material sciences to agritech and health. So we cross 5 different pillars.
So Bob, we do the same thing, and we just have a little bit of tech and product in there as well. So life science is about 30% of our fund.
Yeah, and we always leave reserve. So we come in early with the intent to stay in for the while.
And so what is your secret sauce when you're meeting with founders and they're talking to other investors, potentially angels, potentially state money, potentially leads, other operators? What is your secret sauce? Maybe 2 things that, besides the check, that you help the company and the founder with to execute and create value?
So for us, it's a bit of a nightmare for you in the audience because we are very operational. And that can be really good or that can be really bad. But given that we've both operated large companies, we get in the grill a lot. And so we don't just invest and walk back. So I think the definition of our secret sauce, I think that's one of them because we are so operational. We're so passionate about our investments that we get into the weeds pretty quickly. So that's
Do you take board seats or board observer?
Yes, we take board seats in all of our investments.
So I follow Bob's sentiment on that. We do the same thing. We take board seats. We get into the nitty gritty. We're very clear before we write you a check that we don't just write a check and walk away. We are looking at more results and result driven for our investors. This is happening more and more in the industry. Companies need to be aware of this. I've got several family offices in Calgary that this is also how they look at it. They will not cut a check unless you let them in to give you resources, help build the company, and help drive it forward. So more and more investors are trying to reduce their risk by being operational.
Yeah, I think compared to either side of me, we're less in the operations. A lot of our specific value comes from the specific spot that we sit in the state of Utah. We're quasi-public. We were created by the state. We have close ties with academia and obviously with industry. And so the network that we work within, the connections that we have in the state are really unique. And so that's part of our secret sauce. And then also we're competing less because a lot of our mission revolves around the state filling the gaps where their market doesn't. And so if a round is oversubscribed, we are more than happy to step back and say, the market has this, we're going to step back and let the industry fill it.
And are you looking to invest in companies to get to profitability, to get to acquisition, public? How are you thinking about your exit returns models?
So our definition of exit is pretty flexible. We like to stay in long, but we're also willing to get out early. So
Have you done secondaries?
We have.
Okay.
Yeah.
Do you want to define secondaries for the audience? What those look like?
Well, my definition of a secondary is the same thing, the definition of maintaining enough dry powder for the secondary investment. Correct? Would you guys define it differently?
No, I would define it the same way. I think for us, we want profitability too. And I think a lot of founders need to realize you guys are so hyper-focused on exits that another one of our hesitations is dilution. And so if you can exit us before you dilute us, or at least give us the option, just know that that is a really great way to make good friends with early investors and angel groups, to know that you are taking care of the people that come in first and that took a chance on you first is going to be huge moving forward.
On that note, how do you think about founder ownership? If it's a sole founder or a founding team, do you have a target that you'd like to see them within a range to make sure they're incentivized as well along the same lines?
Yeah, founders, as I mentioned, that's one of our critical components of our success is profiling the founder, the team surrounding the founder. We want to incentivize all team members that they're driving for the same purpose. So they get a fairly healthy chunk.
Yeah, I agree, and especially you have to project forward to that future dilution and ensure that team's going to stay incentivized. Depending on how many founders there are, that number can vary. But I think that there is an opportunity at the really earliest stages to set that company up for success later, or to make it where it'll be uninvestable later because the founders don't have enough equity and aren't properly incentivized.
As a bootstrapper, I would 100% agree. Like, as an entrepreneur, I have made the most money in my life. I've also lost the most money in my life as an entrepreneur. I think being an entrepreneur is one of my biggest risks and biggest assets. So we have to recognize that, and we have to incentivize them enough to move forward, not have side hustles, not be distracted. And at the same time, we love founders that have exited and then reinvested in what they believe in. So also realize that if you're asking us to take, if you've exited, if this is like your second time exiting a company, it really makes a difference to us when you've put skin in the game off of the profits you've received in the past.
Yeah, I think something related. I often am getting the question of like, when do I quit a day job or leave, some other chips that I have on a different table? And I think that there's a lot of answers there, but ultimately, if you're asking somebody else to commit to your company, then you need to have already committed.
We talk to a lot of founders who are physician founders, surgeon founders, researchers, or engineers. And one of the questions we ask is, are you willing to leave your day job for this? Like, do you believe in it so much that you're willing to pay, health insurance, benefits, all of these things? And oftentimes we get this deer in the headlights look back and we're like, okay, like, let's talk through this. Like, you have this amazing intellectual property, the opportunity is very real. So how can we help that founder find the right partner? And maybe it's through an incubator, maybe tech transfer, for example. We spend a lot of time with universities and tech transfers. and in helping that founder not lose the company, not lose the idea, but also if their goal is to pay their mortgage and feed their family, they can't bootstrap, so it really does take the different persona. And I feel like probably all of us on the stage have been in those shoes as well, and what that entrepreneurial journey is like and how scary it is. But also, like, if you believe in it so much and you're really willing to jump in head first, that's a big, strong sign for investors. On a tactical note, we can shift into safes, convertible notes, priced rounds with warrants. I mean, there's a whole mix of things that we see even in very early stage companies. Would love to get the panel's thoughts on, do they have a preference for one or the other at an early stage, safes versus notes, or are they really looking to be in a priced round? Are warrants a signal of distress? Like, let's jump into this meat here.
For us, it's really about having the cap table clean and making sure all the paperwork is done. On notes, it's about having a clear direction on how that note is going to exit. So we have a lot of people that will, put notes together and then say, oh, maybe we'll exit at 2 million. Maybe our cap table will be worth 10 million. Well, 2 million to 20 million or 2 million to 10 million is quite a big difference when you're doing convertible notes. So just being very clear and, once again, very honest with your investors on, here's what our value is going to be. We're doing a note right now. It's going to be convertible. This is what the rate's going to be. And just recognizing that that is a big game changer when we know for sure what's going to happen and what we're going to gain and lose in that.
Yeah, most of our investments are on safes. We have maybe a note and 1 or 2 priced rounds, so we're very heavily in safes. And I think to the negotiations piece is that we come in not as that first check, and a big part of that is the legal drain that happens in some of the negotiations related to that first check. And so I think there is an opportunity to find a champion, find that first dollar in and come to terms that make sense for investors and make sense for you as the entrepreneur. But then once they're set with that group, like, those are the terms, and that's how that round is going to go.
Every time I have this question, I like to think I have it figured out, but it changes. It changes literally. It's almost like black magic. I think that the bottom line is to keep the clean cap table, the understandable. There are serious implications behind each of these decisions. And so every time we take each one very serious, but it's got to be malleable to accommodate to the specific investment.
And there's descriptions I've heard from all different founders. It's some people say it's just as hard to get a $1 to a $5 million check as it is to get a $10,000 check. So also, like, your time is extremely valuable. You have to finance to operate your business and drive to results. So really balancing that part of your day and your time is important. So if you have an investor who's willing to lead, like, keep moving forward. In regards to safes that never end, or a safe that, originally it's a 35% discount, to incentivize people, and then the safe stays open and it's like a 20% discount. And, like, we've seen all different scenarios. And you have a safe that closes and then they don't do a priced round because they haven't hit the milestone. So they then open another safe. I mean, it's just like, there's you talked about dilution risk here, or maybe you've had a priced round and then you have a convertible note. Can you describe some of these scenarios, or what to maybe stay away from in these?
The biggest thing that I can give advice on is, please have confidence in yourself. You're having a lot of conversations, and you can't change with every single conversation. We as investors have to know what you want. It's just as if you were, I'm going to simplify this as going into RC Willie's and buying a couch. They don't say, well, the couch is $200, now it's $500. Oh wait, now it's $5,000. Like, we
Love that scenario.
And so that to me is going to be, I think, the entrepreneurs that I've seen get funded the quickest, because keep in mind, I have 2 sides to this, where we bring investors together, but we also have the fund, which is the NW fund, where we invest ourselves. And so I think the entrepreneurs that I've seen get funded the quickest, the least amount of times with the biggest checks are the ones that are very clear in the subject and very clear on how they're going to exit and what will happen if somebody comes to you with a $2 million check and they want you to go to IPO. How will you take care of them? And the more clear you can be on all these subjects, the easier it is for us to make a decision.
Yeah, I would just add on the question of kind of the safes that never end is the investors who are there the earliest should be compensated for that early risk. And so if you're not thinking about it in that way, then you probably are doing them a little dirty.
I think this goes into my next topic, which is about governance. So everyone described, a board seat, having some form of governance. I have seen companies that have a lot of angels and maybe a couple of financial investors, and then also independents. I've also seen companies where they're like, we're good, we don't need a board. It's just a couple of founders, we're good. And then I've seen companies where it's 3 board members, maybe a chair, a financial investor, and an independent. I mean, I've seen a whole range and a mix, which I think then shifts again when there's like another priced round, maybe some early investors come off and maybe more operators or late stage investors come on. Can you describe how you help support the CEO through these? Some of these are really challenging conversations because some of the early investors that came in have been on the board a long time, but then the next round, wants to redo the board. So how do you support the founder and the CEO through those conversations?
I haven't been through that yet, so I'll let these two take that.
Well, the support of the CEO is critical. As I mentioned, we mandate a board seat for all of our investments. We mandate for that reason that we work so closely with the CEO. There was a talk earlier today that said it's the loneliest position on earth is being a CEO. And to have that experience from, those that have been there, done that, it helps tremendously. And so for ours, we make it really simple. I mean, they know that when we invest with them, they know that they have us for life.
Okay, I'm going to say this is one of my biggest pet peeves because you as entrepreneurs need to get comfortable with being uncomfortable. Don't hire your friends. Don't hire your neighbors. Don't hire your first investor. Hire a diverse group that will challenge you and be truthful. And through that challenge can build trust that you have the confidence to do your business right. A lot of times the reason why board seats, like people will people will invest $2 million and then want to get rid of your board seat is because your board seat is full of the same people. You're not diversified with a lawyer and an IP patent and a business consultant. You have hired all your friends and family that you're comfortable with, and none of them are telling you the truth. They're not telling you the blind spots that you need to see. So this is a section that we work really hard on, that if you already have a business consultant and you need a lawyer, we'll look in our LP base and we'll see who's a lawyer and we'll add a lawyer to your group. So it doesn't have to be somebody who sits on our fund to be part of your board for us to write a check, but we do need to have participation on your board, even if that means we're filling in a gap that you have. And so that would be my advice.
I would say that's a real value add. It's inspiring to hear. What about at the universities and beyond tech transfer? Maybe for the group in the room, if you're thinking about starting your board or mapping out what your board might look like after you raise, are there resources here in Utah for founders to learn about board governance or how to prepare or find board members?
That is a great question. I don't know what resources the universities themselves have. I know we do have a lot of university folks in the audience, if anybody can fill my gap here. But we don't have much of that under Nucleus. I do believe some of the universities have those resources.
And I've seen that across the country where, founders really have to talk to each other and ask, how did you do it? And so finding those peer groups of founders, which is what I love so much about BioUtah, and the ecosystem that has grown tremendously over the years since I used to live here 10 years ago, this didn't exist. And just the fact that there's founders who've exited, there's so many public companies here now, the resources across the spectrum, not just life sciences, not just diagnostics, biotech, med tech, health tech, deep tech, add a tech to it, right? All right, so what keeps you up at night? A lot of things if you have little kids, but if you don't have little kids, what keeps you up at night about being an investor? Yes, speed round. No, I think we're 4:10, so yeah. But this is important for the founders to know what keeps investors up at night.
It's kind of an unfair question for me because I don't sleep. I literally average a couple hours a night, and I think it's because of the things that keep me up at night. There are so many things, because I love this counsel that you just gave about being uncomfortable. I love the thought because once you're uncomfortable, it's like I'll give you a story. My son, several years back ago when I was running a company, he came to my office and I wanted him, as he was thinking about career changes, I said, go out and work with the staff and come back to me and give me a report at the end of the day. And he went out and he worked with the staff, and he came back at the end of the day to me and he was pacing back and forth, and I said, well, what's wrong? And he said, I just don't get it. And I said, well, how can I explain what you don't get? Who can I pull in to help you understand what's going on? And he said, I don't get it because everyone out there is so much smarter than you are, but you're their boss. And I said, you've just discovered the secret to my success. But and so by being uncomfortable, I love that counsel because I'm uncomfortable every night because I'm not sure that this is not only a founder play, it's the founder and the team that he surrounds himself to be uncomfortable knowing that people are smarter than him. So that's one of the things that kind of keeps me up at night is just knowing that do I have the right team in place, and is the CEO sufficient to get a team around him that's going to drive this to the value we need?
I would say the companies that the science might work, but nothing else does. That everything we've talked about here, governance, cap tables, and unfortunately, there, especially in life sciences, I think there's a lot of companies that fail because of science, but also there's a lot of companies that fail because they can't figure out these other pieces, which probably is because they're not surrounding themselves with the right people to help them figure those out. But I think everybody in this room is here because they care about patients. They care about solutions that are going to get to patients and help improve lives. And unfortunately, it's not always bad science that stops that from happening.
Okay, for me, there's two things. So one, I come from an industry that you can't fail, period. If you fail, your reputation is ruined. So when I came to the startup world and people were like, oh, I failed, I learned from it, it was great. I was like, whoa, what's happening? And so I still take that very seriously. So the first way that I do not sleep is if I've recommended a company to the fund and they failed. I understand that our LPs, this is their retirement, this is their generational wealth. This is a risk that they are taking, believe it or not, just as much as you as the entrepreneur, because they have to be, these are high risk investments and they have to be as resilient as you. So that's the first thing that keeps me up. The second thing that keeps me up is honestly, the second thing that keeps me up is this idea that I invest in you and you sell out and you have a worldwide problem that's going to solve a disease and it gets sold out and it never goes to public. That to me, man, my heart just breaks. And when are we going to stop selling out in life science?
That's a really great point. It's almost a dual-edged sword as well, because there's something known as the founder syndrome. And so you hire founders that sometimes don't want to let go when they need to let go. We always talk about fast fill, quick kill. Sometimes you need to acknowledge where founders, especially you mentioned physician founders, and it is their baby. And the best advice you can sometimes give them is tell them their baby's ugly. And that's the hardest thing some of the times that we can lose sleep over, because that's such a difficult discussion to have. But probably the best advice you can give. So on the other side of that sword is to tell them when it's time to quit.
So true.
And at the end of the day, investors, they're investing in you and the team. And they, as you can see, like they're up all night too. So it's either their personal money, their family's money, their state's money, and they have to report to a board and potentially the governor, right? So, unless you have deep, deep pockets and there wasn't a purpose in making the investment in the first place, that's probably not the right investor for you anyways. And, I think the 2 times when I got very scared was when I wrote my first personal check as an angel. You're like, it was a $20,000 check in a diagnostics company. And it was so scary and exciting at the same time because I believed in the founder so much. It was in the traumatic brain injury space. And, just the potential here is so huge, but also so scary because, like, for us personally, like $20,000 is a lot of money. Like, I still have little kids, like, have to save for their college, a mortgage, things like that. The other scary time was when I had other people's money. And so raising a fund and then putting investments to work and then, conversations for follow-ons and dilution. And, that's really scary because these people, as you mentioned, Tomi, like these are people who, single moms or first generation or foundations, health systems. And, every dollar matters. So those are the things that also keep all of us up at night, I think. And I think also just the amount of time we have in a day and all the opportunities. I mean, the pipeline for us is tremendous. And we can only do a certain number of deals per year or per fund. And so just that funneling the pipeline and the amount of time it takes to do diligence. Would love to hear about the diligence process. Like, how would a founder submit their deck or get to know you? What do you recommend for founders who are raising right now?
So we're seeing a couple of due diligence: AI due diligence, lawyer due diligence, and investor-led due diligence. We like to see the investor-led. What are your investors saying? How was the committee put together? How did they dissect what you were doing and then give feedback? How did you address that? Yes, as soon as we raise this amount of money, this is where we're going to fix that. When we raise this amount of money, that's how we're going to fix that. Those are the type of things that we look for in a due diligence. As far as applying, we have an application process that you can apply through DLM.
How many deals are in your funnel, or do you get per year? Do you know? Or per week or day?
Yeah, so we get about 3 deals per week. Right now, we're currently invested in 24 companies, and our goal is to, in this fund, before we move on to our next fund, and our goal is to invest in 10 more.
Our process is pretty straightforward. There's an application online. If you start on our website, you can click a couple links and you get to the application. From there, our process is a little different in that it's a student fund. So there's students across Utah, some of them are here, that do all of the due diligence. And so throughout that process, the founder is working directly with the students. They're taking the pitch, they're doing the financial models, looking at the data. We have undergrads, we have MBAs, we have PhD candidates that are really diving into all of it. And so that's our process from there. And then we have internal reviews with the managing directors, and then a final decision from our external investment committee.
So like start to finish, if you're interested in a deal or students are starting diligence, how long is that process?
Yeah, start to finish, partially depending on success fundraising in other places as well. I would say about 3 to 4 months. So it can be a little slower than other early stage investors just because we have a lot of levels of support and layers.
Although we're about the same time frame because we meet once a month. So by the time you go to our website, you apply for an application, we get you in, we do a pre-screening, and then we meet once a month as advisors to decide who moves forward in that process. It could be 3 to 4 months on us as well.
So that's a great question for founders who are raising. Always ask a lot of questions. What is your process? What's your check size? What's your timeline? What's your investment committee? All the diligence questions, maybe even before you have the pitch.
Yeah, I do want to let Bob get his last word, but I will double stomp that. The number of times that an investor has somebody approach and they are just spitting 1,000 things at you when it turns out they're not in your investment thesis at all, and you're just kind of waiting to tell them is a lot. And so taking a few moments to get to know the fund or the angel, what their investment thesis is, what their check size is, whether or not it's a two-way match is going to save you a lot of trouble. And what you think are a lot of no's are actually just a lot of truly like, this is never going to happen.
So very briefly, I guess the only thing I can add is, yeah, we follow a very structured process, but it's based on history. It's based on how we've done it in the past. But if you haven't figured it out, the rule books are changing almost daily. You mentioned, AI and the impact that that's having. I mean, some of the lectures you may have heard this week about virtual humans to help be astute with what is changing around you because it will help compress those timelines markedly.
And just as an added note to that, really saying how you're using those technologies to advance your research and what you're working on quicker. Because if you are not using these technologies, you've already lost the game.
All right, we have 25, 30 seconds speed round. What are you most excited about in 2026 for the future?
Oh my gosh. Yeah, so we just saw a deal where the whole respiratory system for infants and tracking infants goes from several wires with patches to one little patch on their body. Super excited about that.
I'll keep it really generic. This is just like science fiction these days, guys. It's so exciting.
I'll say again that I'm very excited about this virtual human model. It's changing the way we think. It's compressing timelines. It's reducing costs. It's getting data in front of us, in front of you much earlier to kill projects when needed or keep them afloat.
Ditto.
Awesome. Well, thank you everyone for listening and hearing some of the inside baseball.